All right, welcome back, everyone, and thank you so much for tuning in to the Velocity channel. I wanted to go ahead and address a very important question that has to deal with first position HELOCs. And I thought I might go ahead and explain it on this type of whiteboard instead, okay? Because I really want you to get this concept. And I want you to, for those that have the home equity lines of credit, matter of fact, I'm thinking of one person right now I need to get back with you. And, we really need to discuss the type of banks, all right? And this will be a one-on-one that you need to use in order to get the best and highest quality HELOC for your home. Okay, so let's go ahead and get into it. Before we get into it, go ahead and like, share, and subscribe. Make sure that all individuals that have money, absolutely, that have lines of credit are utilizing their lines of credit in the optimal fashion, in a very optimal way, effective, efficient. That's the name of the game, especially now. So let's go ahead and get into it. All right, we're going to talk about first position HELOCs. And we're going to show you how to go ahead and pay off your whole house with that first position HELOC. So, man, before I get into this, look at this. We have to show you that there's a difference between HELOC and HELO. Many of the bankers are going to try and get you to sign up for the HELO. But listen to this. Just say no to the HELO. You remember Dare to Keep a Kid Off Drugs? I know I'm dating myself, huh? But remember Dare to Keep a Kid Off Drugs said, hey, just say no to drugs. You remember that? That whole campaign? Just say no to the HELO, all right? We do not want that. We want the HELOC, okay? So let's go ahead and erase the HELO from our vocabulary. We need to erase the HELO also from our bankers' vocabulary. We do not want the HELO. And if they try to sell a HELOC that shows you, well, these are the scheduled payments. These are the scheduled payments for your HELO, let's just say $1,200 a month. You got to ask them this question. Okay, well, if I were to pay the principal payment, let's say your principal payment was $30,000 in total, and you wanted to pay the principal of $10,000, right? So now that would equal $20,000 left, right? Ask them, okay, so now what would my payment be? And if they say, well, your payment would still be $1,200 a month, you let them know, why is my payment scheduled? And then you get with me, okay? And I'll ask them, hey, why did you do that? And we'll put together some strategies that you can use. And of course, this would be a one-on-one basis to get out, okay, if you've already signed up for that product, to actually get out of that product as quick as possible. Because that's not what we want, man. We don't want that. We don't want scheduled payments. Now, is that a big deal? No, of course not, because you know the velocity banking method and you know how you're going to be paying that home equity line of credit. But we do not want these scheduled payments. Scheduled payments, it doesn't matter what you pay on the principal. It's still that those payments are still going to be the same. We don't want that. We want the first position HELOC. Okay, what does first position HELOC mean? First position HELOC means we are replacing our mortgage. That's what that means. Plain and simple. So we're going to be replacing our mortgage with that first position HELOC. Let's go ahead and say that, you've got a $300,000 mortgage. Okay, and you know what? You've been faithfully paying that mortgage off, and let's say you've got it all the way down to now Okay. What's the approximate equity in that? Okay. What is it? 200,000, right? Because it's worth 300, right? Let's say. And now you've paid it all the way down to 100,000, right? And so that's 200,000 in equity. So what's the most the bank's going to get you? Like 90%, maybe 85%, okay? But there is a way, and there are banks and credit unions that allow you, right, to, with this $100,000, right? They allow you to say, well, wait a minute, sir, ma'am, you've paid this down so far. Let's do this. Instead of refinancing with us, shout out to 1AZ. Instead of refinancing with us, why don't you just put the HELOC in first position, since you have all this space in here? Your house worth 300,000, right? House is worth 300,000, and you've paid it all the way down now. So at 100,000, you've got $200,000 worth of equity there. So let's do this. Let's go ahead and place this in first position. Let's place that in first position. Well, what happens next? What happens now that you have a first position HELOC, okay, and you no longer have that mortgage? Now you can rapidly pay that off. Why? Because when you get your income, instead of putting it in the bank, you got to catch this, all right? You're going to put it in your house. I said, instead of putting it in the bank, watch this. You're going to put that income in your house. And instead of looking at your bank account and like, man, I got all these bills to pay. Now you're going to pay the expenses from your house. Why? Because you got the HELOC, and your HELOC is in first position. You see, you couldn't do that with the mortgage. You couldn't do that with the mortgage. Because with the mortgage, those payments are only one way. And what's that way? Away from you. So we have your income going inside of the home equity line of credit, since it is in first position, right? You've got enough equity, right? You got enough equity in your home to replace that mortgage, right? So now the mortgage is thrown away, and your home equity line of credit is your own velocity banking tool, so that you can do like that one client, right, that I got to get back with. Come on, you know your name, huh? Protecting you for anonymity purposes. Please don't be mad at me, all right? Look, since it's in first position now, all right, you're on a whole nother level. You're no longer using or segregating your costs. You're no longer segregating your income. You're aggregating it. You're pulling it all together, and you're using it to pay down that line of credit. Because let's say your income $5,000, right, and your outgo is $3,000. You're putting it all inside of this HELOC, okay? Well, what's the difference between 5,000 and 3,000? If you said 2,000, give yourself a gold star. And that, my friends, is what's sitting in your home equity line of credit. That is what is paying down your home equity line of credit. So let's go ahead and figure this as a home equity line of credit. Okay. Let's say you have, what is it? You're paying down the 100,000, right? Okay. So how long is it going to take you to pay down that 100,000 effortlessly? Okay, effortlessly utilizing the velocity banking method in this way, right? You're going to see the cost go from here, take down here, take down here, and take down here until they're all gone. How do I know? This is how I know. Let me go ahead and I will show you how I know. You're taking this 100,000, okay, and you're going to put it in a calculation, and that calculation is going to be 100,000 divided by 2,000. All right, now watch this. This is not trickery, and I'm not trying to trick you. All right, you're talking about getting rid of mortgages now. You're talking about no longer having to be in a mortgage for 30 years. Okay, now they have 40-year mortgages, right? But you're talking about getting rid of mortgages with a home equity line of credit. So let's go ahead and divide this the CJ way. All right, we're going to take all these zeros. Trying hard not to use our calculator here. So those zeros don't exist. Now it just becomes 100 divided by 2. So what's 100 divided by 2? Double check here. Boom. So 100 divided by 2 is 50. Okay. So 50 what? 50 months. $50 months. Which means you would have paid down $100,000 in 4 years and 2 months. Get this, on $5,000 a month. Now, by no means do you have to pay it off in 50 months. I mean, if you want to go on vacation, you can do that with the money. If you wanted to, maybe, give some to charity, maybe want to buy another property, you can do that as well. The fact of the matter is, you're utilizing the home equity line of credit. You're utilizing the first position HELOC for your benefit instead of the bank's benefit. Does that make sense? So that's what the first position HELOC is. It actually replaces your mortgage. Put that HELOC in the first position, okay, and replace your mortgage all together. So I wanted to just give you that as an aside there, so that you can take this knowledge with you and remember that all these numbers are going to go inside of a formula. Absolutely. You're also going to keep in mind that, and let's go ahead and erase this. You're going to also keep in mind that the cash flow index is how you're going to determine which loans to pay off first. You're like, man, but CJ, I got 50 loans, I got 50 houses, I don't know which one to pay off first. This is the formula you put your numbers into, all right? Many of you, you're giving me numbers, you need to put them in formulas, all right? And this is the formula, all right? Loan balance, and these go with lines of credit as well. Loan balance, we can call it LB for short, divided by MINMO. What's MINMO, folks? That's right, a minimum monthly payment. Okay, we can also do LB divided by MM, minimum monthly. And this is what's going to equal the CFI. Now, with the CFI, we want this cash flow index indicator. We want you to know that you'll plug in your numbers here. So say your loan balance is $20,000. This works with cars, credit cards, mortgages, whatever the loan is, okay? Tractors. All right, look, $20,000, and let's say your minimum monthly payment is $600 a month, okay? And well, I mean, why go complicated when you can go simple? You know what I'm saying? Why would you do that? Let's do this instead. Let's say that the payment is $200. Yeah, I love simple, man. So we're going to do this. We're going to cross out the 2 zeros. We're going to cross out the 2 zeros there. So now we're only dealing with the simple 200 divided by 2. And that's 100, right? That's 100. So what does that mean? If you have a loan like this, that means you'll put it on a scale from 0 to 100. Okay, let's say 50 is in the middle. 0 means it's an inefficient loan. Inefficient. It's an IL. It's ill. Okay, it's ill. So just think of being ill. An inefficient. It's an inefficient loan. And the closer to 0 this number is, okay, the faster you want to pay that off. Okay, that's the priority in paying it off. Now, over here though, right, on the right-hand side, you see that? Is the efficient loan. Think of El, right? El is the ancient Hebrew word for God, you know what I mean? So El is an efficient loan, you know? And that's just the way it goes. Freedom zone, okay, is going to be reached when you get here. Danger zone is reached when you're between 0 and 50, and then caution zone is anywhere from 51 to 99. Okay, so what does that mean? What does danger zone mean? Danger zone means that you got to pay that off quickly. Pay off quick. All right. You say, but CJ, I consider all of my loans danger zone. Right. But you got to prioritize it first. Okay, prioritize it first. Free up that cash flow, and then put that cash flow into paying off your other debt, paying off until you are building your wealth now, right? You're starting from the ground up, okay? Caution zone, what does that mean? When it's in the caution zone? Well, it's when the loan is in the caution zone, you can either refinance, right? You can restructure, all right? You could lower, ask them for a lower interest rate. You'd be amazed at what happens if you just talk to the bank yourself. You know what I mean? If you can just talk to the bank yourself, they'd be like, man, okay, fine. We'll go ahead and give you that check return fee. You know, you just made a mistake or whatnot. You know, they do that. If you have like a return check or something like that, you thought the money was going to be there and it wasn't, just talk to them. They're human beings. They're not all bad. Okay. So you need to get out of those big banks. Okay, they're not going to be forgiving. Get out of them and get into a credit union. Go to where you're appreciated. Absolutely. Let me say that again. You got to go to where you are appreciated. All right. Now listen. I know that I haven't been as, and this is just a confession that I'm making on air. All right. I haven't been as consistent with my follow-up with you guys as I have. You know, many of you have reached out to me and it's like, hey, man, I'm waiting for some help. Man, hey, I want you to get the best help available. And I want to give you my full attention. There's been some things, man, that's been going on, you know, that has been trying to hinder me. But listen, by the grace of God, I'm not going to be hindered. You guys are the priority, man. So I want to make sure that I'm giving you my full attention instead of 50-50. You know, there's no way, you never get a second chance to make a good first impression. So that's what the deal was over there. I actually let someone know recently, hey, you are the priority. Here's my Zoom, because I set it up on my my app to go ahead and just knock it out. You know what I mean? Knock it out. And so, listen, this right here, this method of paying off your loans is a proven method. It's a proven method. Look at the freedom zone. This is where you want to be, right here. Okay? We don't want to be in the danger zone. Okay? The inefficient loan zone. Now, if you have a loan like this one, okay, that has that cash flow indicator of 100, then what you'll need to do is make sure that you never pay that off. Now, of course, I'm just teasing. Okay, you got to pay it off, but that's not the priority. What the priority is are those loans that are between 0 to 50. And if it's closer to 0, what are you going to pay off first? The one that's closer to 0. Absolutely. And so we just wanted to go ahead and give you that information there. We'll go ahead and back all of this up and make sure perhaps you didn't have a, can we not do that? No? Oh, no, we can. It's just being really slow. Yeah, so make sure that you have everything that you need to succeed there. And listen, if you have any questions, there are no stupid questions when it comes to finance. Okay, folks, we do need to read the fine print because sometimes the big print, it gives, doesn't it? But the small print, it takes away. And so we are going to do our best and do what it takes to actually give you some updates on how to implement the velocity banking method in your certain circumstance and how to get that house paid off if that's your priority, get that car paid off, get your student loans paid off using these lines of credit. And even if you don't have a line of credit, so what? Guess what? You have a checking account. Okay, listen, savings account, we can do it through retirement accounts, even what is it called? What's that called? Infinite banking. We have that as well. And so if you guys wanted to go ahead and take a picture of that, go ahead and take a picture. Remember that the first HELOC is going to be replacing your mortgage. So really it's a replacement of your mortgage. All right. So we wanted to give you that and also let you know that CreditWiz and InvestorPro.org, if you need assistance in this and implemented it in your current situation, just let me know. You can also be a member of Velocity Banking Evangelist, right? So that we can also clue you in on a closer and a deeper financial foundation for you and your family. Because Velocity Banking, it's just the tip of the iceberg, folks. It's just the tip of the iceberg. Okay, so we definitely have more to say on that. All right, listen, folks, thank you so much for gathering with me today. And man, contact me if you need help. Remember, if you need a credit card, the description links are down here below. All right, and that's what's going to assist you in building your credit, as well as starting on that road to building your wealth. All right, folks, God bless, and you have a great night.